JP du Plessis from Methodical. JP, thank you so much for joining us.
Pleasure. Good afternoon, just turned afternoon to everybody today. I'd like to subtitle this presentation, Lots of Questions and hopefully a few answers. I don't have all the answers, I wish I did, but I've got lots of questions. I guess that's a job of a portfolio to constantly ask questions about what's going on in the world. And that's what I do every day. So some of these questions, we had US jobs data out on Friday. What's going on there? Does it point to a slowdown in the US? Is US monetary policy restrictive? Nolan touched on it a little bit. I'm going to touch on it a little bit more. Nolan also talked about the inflation target, the new inflation target in SA at 3%. What does that mean? What are the implications for central banks and bond markets? And then a little bit about the ultra long end of the curve, of the bond curve. And then finally, I used to have a boss a few years ago who would always ask, "What's the trade?" It's all very well talking a lot, but what are we going to do with all this? What are we going to do with all this information? So my final slide is what differs a little bit to Nolan's view. So we'll stick around for that. Okay, so this is the 3-month trend of US jobs data. And what we've seen, if you look on the right hand, for those of you with good eyesight, the look on the right hand side there, you can see that the US jobs data has been trending down. And if you look at that sort of level, historically, you've pretty much always had a recession. So it went through that level in COVID, through that level a long way. I had to cut off the graph in the global financial crisis, the tech bubble, and then crises that some of us are too young to remember. That happened before that. So I'm not necessarily saying that we're heading into a recession, but certainly the jobs data and the growth of jobs. Now remember, we're still talking about jobs growing in the States. We're not talking about jobs declining. So the jobs number on Friday was 22,000 new jobs. But typically when you start to see a lack in that job growth, i.e., they're not putting on as many jobs as we've seen historically, that tends to be a foreboding of recession. Why is that? Well, it's a natural human thing. If it's not easy to give up your job and get another one, then you think twice about your job. And if there's some uncertainty about your job, then you don't go out and spend. And that's obviously with a very heavily consumer-driven economy, that's been the case. What's causing it? Some of it might be tariff uncertainty. Some of it, anecdotally, might be with the younger employees, people who've just left school or left varsity, that there's this whole AI revolution, and that maybe big companies aren't rushing out to hire junior analysts, junior lawyers, junior accountants, because they're thinking about what they can achieve from a tech perspective. But whatever is causing that, we are seeing a downward trend in jobs growth. My clock's not started again, Eugene. I know. I could just talk forever. Oh, there we go. I won't do that to you guys. Don't worry. Is US monetary policy restrictive? So that's a question. And obviously we've had the orange man in the White House who thinks it is and has been banging the desk very hard to say that those evil people at the US Fed should be cutting rates aggressively. But what we're seeing actually is, if you look at the end of the graph, we're seeing some, it's not tremendous monetary growth, but we're seeing 5% monetary growth. We obviously saw monetary growth fall off a cliff when we saw those interest rate hikes, and also somewhat from the banking crisis that that happened in the smaller banks in the US, where lending went down. But we are seeing some monetary supply growth, which doesn't indicate that rates are necessarily too restrictive. I'm not going to go through this in great detail, but Scott Bessent, the US Treasury Secretary, a few weeks ago, was on, I forget whether it was on CNBC or Bloomberg, and he went, there's no model in the world that says US rates should be shouldn't be lower. Well, virtually every model you can look at says that actually rates should almost be higher. So there's sort of one way view that actually there's some kind of aberration at the Fed and that the Fed's like completely lost the plot because every model tells you that interest rates should be cut is not true. So this is the Taylor rule, which is quite a well-known rule, which looks at unemployment and it looks at inflation. Now remember, inflation's above target and unemployment's still very low, 4.3%. In the US. We only dream of having a unemployment level of that low. So nothing at the moment is saying that the Fed should be cutting rates aggressively. Okay, the question mark is, are we heading to a slowdown, jobs growth? The US housing market is looking a little bit shaky. So, is there potential for a supportive rate cut? Yes. Is it going to be a massive rate cutting cycle? No, unless we see a real continuation in this, and we actually end up in a recession. But we're certainly not at a stage where they need to go and kind of rush to cut rates. So we talked briefly about SA inflation. I'm also a fan of Kenyahu, and I don't know many people in the fixed income market who don't like Lesetja Kenyahu, the leader of the Reserve Bank. But I do think he's drunk the central bank Kool-Aid. Which is, it's easy to do because, remember, central banks tend to spend a lot of time with other central bankers, and they all think that they sort of know everything and can control the world, and to some extent they do. But the reality is, a lot of our inflation is driven by things that are out of the control of the Reserve Bank. We think about, inefficiencies in listed prices. We think about food prices. A lot of that comes down to weather conditions. The rand, often it's buffeted by external things. So yes, if they put interest rates up to 25% tomorrow, that would send our economy into a screeching halt. But at the margin, they don't necessarily control inflation that tightly. And what we've actually seen in past bouts of inflation is really rand weakness. So these lumps here in the early 2000s and around the GFC were around rand weakness, and it's the thing that the central bank keeps a close eye on. And I'm going to talk a little bit about the rand later. But the interesting thing here is that we've averaged an inflation rate of 5.9% since inflation targeting in 2000. So it's not like we've conquered inflation. Yes, we've had inflation at lower levels more recently, but a lot of the things that have driven inflation in the past are still there. They haven't magically. So I think it's quite optimistic. I shared kind of Nolan's view on this. It's quite optimistic to think that we've completely slayed the dragon of inflation, and it'll be interesting to see the response. This sort of cognitive dissonance when you kind of think you've controlled something and then you end up not controlling it. Because if we do have a situation where we have, let's say, a sell-off in the rand and inflation suddenly goes to 6% again, our central bank's going to have some kind of, Lesetja's going to have some kind of malfunction at the monetary policy meeting because he won't understand why that's happened. Inflation expectations have been muted as kind of a big, look, we've got much lower inflation. Organized labor's got lower inflation expectations. Businesses got lower inflation expectations. Economists have got lower inflation expectations. We've conquered inflation. Well done, high five. Well, the reality is, if you look at this historically, the orange is 5-year inflation expectations, and the blue is inflation at that time. Well, guess what? Inflation expectations tend to follow where inflation's been. So we heavily anchor our view of future inflation on what inflation is doing today. You can see as inflation trended down before, inflation expectations went down, not to the same extent, but this is a 5-year kind of view. And then when we had a bout of higher inflation expectations. So I don't necessarily think that the cause and effect is the right way around in this all the time. So you can't, I guess the long and the short of it is I'm not 100% convinced that they've slayed the inflation beast. This slide shows you what's been happening over the last 6 months in global bond markets. So we've got the US here, UK, Japan, which is an interesting one to watch to some extent, the canary in the in the coal mine in global financial markets, and then what's been happening in South Africa. And this is the change in 2 years. So we've seen the 2-year rates in the US and the UK come off, gaps marginally in Japan. But what's happened in these markets is the 30-year rate has gone up quite significantly. Interestingly, we haven't seen that in our market yet. A lot of our market's been driven by, we had a big sell-off in our bonds, and we're seeing a lot of positive momentum in our bonds. But to some extent, this is a kind of a gravitational force. This offshore bond markets are a gravitational force for our bonds. So we do have to be a bit wary when we start to see offshore long end bonds sell off, that our long end might be vulnerable. This is just our bond market curve. You can see here the blue line is where we are today. The red orange line is where we were. So we've seen a move down. It's been a pretty consistent move, and that's been around this relatively well-contained environment. Interest rates have been coming off a bit. Inflation's been we've had a reasonably stable political environment, and globally we've had a kind of risk on, not a super risk on, but not a kind of a muddle through kind of environment. So that's been supportive of our bonds. So what's the trade? I guess I'm going to differ a little bit to Nolan and maybe Brandon as well. But I actually like the front-end inflation-linked bonds because I think in the front-end inflation-linked bonds, you're getting real rates of 4.5% to 5%. So maybe they're not. So I run two funds. My income fund, the Methodical BCI income fund, which I consider the kind of widows and orphans fund. That's where you put the money you don't want to lose, and it grows. The objective is to grow at Steffi +1 and to beat inflation by a significant margin over time. But it also has that risk tolerance in there. So you don't want to be losing money over a rolling 3-month period. And I think for those type, having real rates, getting inflation +4.5 to 5 is not a bad result. If you lock that in government inflation-linked bonds, that's not bad. The downside, obviously, is that currently inflation's 3.5. So if you add that together, you're only getting 8%. So yes, the longer-dated bonds are giving you more, but it's a relatively low volatility asset class, and you are achieving those returns. And if you have some concerns about how in control the Reserve Bank really is of inflation, then that's a good place. That's a good place to be. I do like the belly of the curve. So when we talk about the belly, we're talking about this part here where it's very steep. You're getting what we like to refer to as roll down, which is, if you buy a bond here and you hold it for 6 months, it's down here just due to the shape of the nature of the curve, and that can produce some really attractive returns. So you get 8 and a bit % returns, but if the curve kind of stays where it is today, forget about it lowering, but if it stays where it is today, you can pick up 1.5% from that roll down, which is attractive. And then I used to say this is holding dollars, but that's become a very controversial thing to say. So I like having a bit of a rand short in the portfolio, and I think that helps you if we enter an environment where it turns out that actually the risks that are in the global environment, the risks of the global bond markets are a bit higher than the market anticipates. I think if everybody has the same opinion, or everybody kind of thinks that the world's going to continue exactly as it is today, that tends not to be the case. There's things that come along that surprise you, and having some assets in the portfolio that hedge your SA risk in the portfolio, I think makes sense. That's me.
Any questions for JP? JP, I realize you're also running for the airport, but very insightful indeed. Just one question very quickly. ILBs has been attractively priced for probably the past 18 months. If I invest in ILBs, I got nothing.
No, that's not true, because you have been getting the yield. You've been getting the yield. If you look at where the short end, and I'm talking about short end ILB, so short dated, so the I-2029s, which is 4 years, or the 2033s, for example, you're getting the inflation and you're getting the real rate. So you are getting yield. It's not the most attractive. It's underperformed nominal bonds, that's for sure, because nominal bonds have performed well. But they're a stable part of the portfolio. And if we do see a tick up in inflation for any myriad of reasons, and you look at history, our inflation rate's has averaged 5.9%. You know, there are a lot of factors that could push that inflation back up. So I don't think it's a bad place to right
Can
now.
add value. It's not a zero-sum game.
Yeah, exactly.
JP, thank you very much.
Thanks, Eugene.